I'd like to introduce tonight's speaker, Joel. Joel is a partner at the accounting and advisory practice of Freelandt Caldwell Reilly, a firm of chartered professional accountants with offices in Sudbury and Espanola. With over 75 professionals, FCR serves clients throughout Northern Ontario. So he will be delivering the lecture on financial planning.
So in terms of the agenda for tonight, what I'd like to do is really try to make the session interactive. I've got about maybe 40 minutes worth of slides to talk to you about tonight, take you through sort of getting your financial budget together for your startup. But if you have questions, please feel free to sort of jump in and ask as we go through, because I find this material really exciting. But I hope that if you guys want to get something out of this, I know you're starting sort of early on into the program, but if you've got questions, bring them up and let's sort of go through it. Okay. So in terms of tonight's agenda, we're going to talk about why financial planning is important. What are the basic components of a financial plan? So what are the sorts of things you need to build into your financial plan so that you can move ahead with your business idea? So we'll talk about actually forecasting and budgeting. How do you build up a financial projection, a budget for your startup? We'll do a quick overview of financial statements. So some of you may or may not be familiar with basic financial statements, but you'll, of course, be using these financial statements throughout the course of your business, so it's important to understand a little bit about them. And then financing your business startup. So where do you get that seed money to, or that bank financing to actually get your business idea off the ground? And then I'll point you to some tools and resources that you might be, that I'll leave you with that you might find useful. So your business plan has a whole bunch of different components. And this program, the Entrepreneurship 101 program, is great because it's going to touch on various aspects of your business plan. But I'd argue that the financial plan is really the cornerstone of your business plan. So the finance side of your business obviously has to hold together, and it's a key component to your business plan. So why is it important? Well, maybe it's, is your business idea viable? Does it hold together from a profitability perspective? Managing your cash flow is key. So you might have a great idea, you've done the market research, and you know that you've got an idea and a product that you want to bring to reality, but how are you going to manage the cash flow of your business? Because if the cash flows, you don't plan for the cash cycle of your business, it could put you in a position where it may not be feasible. You need to be able to plan for your spending, so you need to know what those startup costs are. You need to understand, how you're going to collect from your customers and those sorts of things. And in terms of evaluating your return on investment, so when you're in this stage of sort of feasibility, you may be walking away from other business opportunities. So planning and understanding the financial aspects of your business startup is important so that you can make those decisions. So what are the components of a basic financial plan? Well, you start with a sales forecast, an expense budget, a capital asset budget. So maybe you need equipment to start your business. So you need to plan for those sorts of things, obviously. And then you convert your sales forecast and your expense budget into a cash flow budget. And this is, as I mentioned, is critical because the numbers have to make sense. A good financial plan is going to have all of these components. So maybe if I can just get a sense, has anybody sort of started the financial plan of your business startup yet? Have you started putting the numbers together? Okay. Okay, that's good. So when you're looking at your financial plan, you need to look at the horizon. So how many years, typically you want a plan that's 3 to 5 years in length. And because the first year that you get into business is obviously the most critical, your first year should be broken down by month. So you really want to plan your projections and your budget monthly in the first year. And later on in the presentation, actually near the end, I'm going to take you through a real example of what this sort of cash flow budget and projection will look like. And I'm going to highlight a few sort of important takeaways that I want to leave you with in terms of understanding, where you can get into trouble in terms of cash flow in your business. And when you do set this up, you want to consistently revisit it. Things change all the time, so the assumptions that you build into, for example, your sales forecast, may be different. You may have come upon a new contract, or you might, build in another product that could change some of the assumptions that you've built into your plan. So you want this to almost be, a living document, something that you can go back to, build in different variables and constantly adjust. Does anybody have any questions about these components? We'll get into more detail in the next couple slides on each of them. That's the sales forecast is actually the most unpredictable element of your financial plan. So it is the most difficult, obviously, to forecast because you're probably bringing a new idea or a new product to market, and it's very difficult to predict what your sales are going to be. But you want to look at things like, trying to predict sort of the sales pattern. You want to build in, assumptions that are realistic but conservative at the same time. So, we say that, you want to be optimistic, but you don't want to be overly optimistic in terms of your sales, because you don't want to set yourself up for a situation where you don't hit your sales targets and you end up in a totally different cash flow situation than you expected. So you want to use as much market data as is available. So perhaps you really want to understand or test your market to sort of build up what potentially your sales market is. Want to consider things like order backlog. What's the probability of securing certain contracts or customers? You can build that into your projections in terms of your sales. The other thing you can do is, you want to bounce off your budget, especially on the sales side. Well, actually, the whole financial plan, from your accountant or other financial advisor, get some feedback on it. We have the benefit as a public accounting firm with hundreds of clients to be able to really give you some feedback in terms of where we think you are relative to, say, other companies that may be in similar sort of industries or similar size and that sort of thing. Any questions about a sales forecast? Have you guys started your sales forecast as part of your financial plan? Yeah? Okay. There's some really good resources you can get. For example, the Greater Sudbury Statistics Guide can give you sort of demographic information. So if you've got a particular product, where you're targeting a certain demographic of people, you can actually get some of those statistics from, and if you're dealing locally here, some of those statistics are available, and you can use those to test your assumptions in terms of your market penetration or your projections in terms of sales. The other important thing to consider as part of your sales forecast is cyclicality. So maybe your business is cyclical, and building that cyclicality into your projection is important because it's going to have an impact on your cash flow. So we'll talk about that at the end of the presentation. We take you through that example. You'll see how cyclicality can really affect your cash flow, and that could be a good thing or a bad thing depending on how you're set up. So the expense budget. An expense budget is pretty straightforward. I think most of you are likely familiar with different types of expenses. The two main categories of expenses are fixed expenses. So these are expenses that are, as it says in the slide, they're paid independent of business activity. So there'd be things like rent. So they're predictable, they happen every month, and they're very easy as a starting point for your expense budget to build into your model. Then there's variable expenses. So variable expenses change in proportion to something. Typically, your variable expenses change in proportion to your sales, for example. The more sales you have, the more cost of sales you have. So you need more inventory, you need more labor, so those expenses change relative to your sales. So in terms of startup costs or expenses, you want to look at things like initial inventory. And initial inventory is not necessarily an expense at the outset of your business, but it's definitely a cash outflow, so you want to plan for it. Incorporation fees, recruitment, down payments on equipment. You've got to buy equipment. Well, that's not an expense, but it's a cash outflow. Ongoing expenses, so salaries and benefits, right? So you've got to pay your employees, so you've got to build that in, obviously. Rent, interest on mortgages, marketing, office supplies, utilities, etc. So try to think through all of the sort of expenses you're going to have, not only to start up your business, but also on an ongoing basis. What are the expenses that are going to change relative to your business activity? And you won't get it perfect. There's just, you want to build in a conservative, a bit of a cushion to deal with some of the uncertainties. So that'll help you plan. So you start with your fixed expenses. They're predictable, as I mentioned. Cost of goods sold. So this is cost of goods sold. I'll show you where that is in the income statement when we talk quickly about financial statements. But cost of goods sold are things like when your inventory, you sell your inventory. Well, that becomes a cost of your sales, okay? And sometimes that can be a hard number to pin down when you're in the initial stages of your business. So you can often express cost of goods sold as a percentage of your revenues. So you've gone through the process to establish your sales forecast. You're going to target a certain margin on your sales. So hopefully, if you're selling widgets, okay, and you want to make 20% on the sale of your widgets, well, that's how you can back into your cost of sales, okay? Or maybe you know what your cost of sales is going to be. Maybe you're producing something. So you're producing a product that you know has direct materials and there's labor that needs to be applied to actually build the units. That would represent your cost of sales. And as I mentioned, plan for unplanned expenses. So be conservative and be realistic. Capital assets. So capital assets are really, they're longer term assets. These are things like pieces of equipment. A building would be a capital asset. I'm not sure if there's anybody in the room that's planning some sort of a software product. You may not have a whole bunch of capital expenditures. You need a laptop, you need people. But if you're sort of in the traditional type of trying to bring a tangible product to market, likely, unless you outsource manufacturing, you may need equipment, you may need these sorts of things. So capital assets, they're long term. They're things that a business invests in so that it can generate, and help you produce that income stream. There's a return on that investment. So it contributes to a business's ability to generate a profit. So manufacturing equipment is the example. Now typically, this is your largest cash flow outlay potentially in your business startup. So if you need to acquire a piece of machinery, that could be a big outflow at the beginning of your business. So we're going to talk later about, how do you finance the acquisition of that piece of equipment? Do you use your operating profits? Do you use your personal money? Do you go to the bank for a loan? Do you use a line of credit versus a term loan? And I'm going to take you through sort of how you want to match the financing to the life of the asset. Okay, so we'll talk about how you match up your financing to deal with different types of components of your business. So the cash flow budget. So the cash flow budget, basically after you've done your sales forecast and your expense budget, the next thing you need to do is convert those cash inflows and outflows into a cash flow budget, okay? And, really for a small business, especially a startup, cash flow is the most important thing in your business plan, by far. At least the financial component of your business plan. cash is king. And so I'm really gonna, I really want you guys to take away, if anything, out of this presentation, the importance of understanding the cash flow cycle of your business. So understanding the inflows and the outflows and how to deal with financing, because, as a startup, this is what's going to make or break you. Cash is king. You can be very profitable, so you can have a great idea. You can be projecting, what's called hockey stick growth. So you really think after the first year or 2 or 3 or whatever that, your sales are going to increase 300%. Well, that's fantastic. But the way you're structured in terms of your financing, whether you've properly, got the right loans in place to deal with that growth is key, because you can be a very profitable company but be very cash poor. And if you get into what we call a cash crisis, this is where, you just don't have the cash available to take on that business. So maybe you end up with, you've been working so hard to get that order from this key customer. It's finally there, but you're just not set up to take it on. You can't fund the contract to take it on. Okay? And in our experience, so we deal with, our main business is dealing with small to medium-sized enterprises, for-profit type companies. And this would have to be, when our clients get into trouble, it's not necessarily that they're not profitable, it's that they get into a position where they're cash poor. So I'll really harp on that. And if you have any questions about it, I'd like to talk to you about this.
It actually does raise a good question. Is a typical family supposed to have, or an individual supposed to have so many months of resources in case things go wrong in the family? How many months do you think a business should have in reserves in case things go sideways?
Yeah, well, that's a great question. I mean, I'm not sure I can express that in terms of months, but what you want to, for example, have in place could be an operating line of credit, or you perhaps want to have some personal money, like if you're helping your business be funded, so you're actually loaning the company money. Maybe you want to make sure from a personal perspective you're not leveraged through the roof, that you're not taking on more than you can handle personally. You want to have some resources available that if things get going, things get tough in the business, you can actually advance more money to the company. But this is where I'll tie back perhaps later on. I'll show you where, for example, the operating line of credit. So making sure you can go and borrow from the bank on a short-term basis to fund perhaps a month or 2 or 3 of negative cash flows, because you might be, in a business that's cyclical. Or you might have to pay for your inventory, as I'll show you in our example, 30 days in advance, and you're only collecting from your customer within 30 or 60 days after the sale. So you may have 90 days worth of cash outflow before you have any cash in, right? So, I guess I would say that you want to make sure that you're sort of planning for the unexpected, be capitalized property, make sure you're going to the bank at the right time, not when you're strapped, because they're likely not to lend to you. You want to be thinking ahead. And that's why this process is really, really important to go through. So, as startup companies, you guys are known as cash sponges. So the initial stages of your business, there's nothing coming in, it's all going out. So you're cash sponges. And when you're in the growth stage, right, you still need to manage your cash flow, because all too often companies are focused on the revenue growth, and they're not thinking about how to manage their cash flow, okay? They're not paying enough attention to the kind of credit they're extending to their customers. So, you're worried about booking the sale, you're worrying about getting your foot in the door, so yeah, we'll give you 60-day terms. Okay, 60-day terms, that's great, but what does that mean to your cash flow, okay? And, as I said, it's key to making the proper decisions on your financing needs. So you don't know if you need a term loan or if you need an operating line of credit until you've gone through this process. So sources and uses of cash. This just highlights the various different types of activities that result in cash inflows and outflows. Some of these terms, you're going to hear about when you're looking at financial statements or talking to the bank. So operating activities are things like when you sell your goods and services. Investing activities are things like acquiring capital expenditures. So that's an investing activity. A company invests in its capital. Financing activities are things like taking on debt, which would be a cash inflow, or repayment of debt, which would be a cash outflow. So this terminology is just good to know when you're talking with your banker, or your accountant, or whatnot, because there's different categories of cash flows. That's all that this slide shows you. So a cash flow budget really, in its simplicity, outlines the timing of a company's cash disbursements and cash receipts over time. So typically, in a financial statement or in your cash flow budget, that could be a 12-month period, and then it could extend out to, say 5 years if that's how far your financial plan goes. And the basic formula is you start with your beginning cash, you add your cash receipts for the period, so how much cash came into the business, and then what were your cash disbursements? So what went out the door, payroll, inventory, overhead, that sort of thing, and that's going to give you your ending cash. In the example, again, when we get to the end of it, that formula you'll see will hold true, and basically we've got a template set up that you guys could use as a very basic start to your cash flow projection. So it sort of keeps that formula going, and you'll see how it projects out over the months, okay? So what the cash flow budget does, if we're talking about a 12-month cash flow budget, for example, it's going to show you where the peaks and valleys are in your cash flow. So where are you getting to the point where you're perhaps dipping into the negative? What are the months where your cash flow is very positive and you're building up cash? So it's going to help you identify those peaks and valleys, and you're going to use that to help plan whether you need to go to the bank for a loan and whatnot. So you need to build in, obviously the starting point is your forecasted sales and expenditures. And then you need to convert those into cash flow. So you book the sale in January, but when are you actually going to collect that receivable? Is it 30 days? Is it 60 days? So that's the process you'll go through to convert it to a cash flow projection. The other thing to take away, I would suggest for tonight, would be to be mindful of the payments to CRA. So not sure how familiar this group is with HST and payroll, like source deductions. But what you need to be mindful of is when those things become due. So it's likely that depending on what you're selling, you're going to have to charge HST. And HST is 13% on your sales. So you sell something for $100, you're going to collect $113 from your customer, and 13 is owed to CRA. And that's got to be paid by the 15th, or generally the following month, okay? And that's CRA's money, Canada Revenue Agency. So where we get where a lot of clients get in trouble is they don't pay enough attention to when those things are due, okay? So if it's payroll and you're paying your employees, you're withholding taxes on their salary. You guys are all familiar with that. That goes to CRA, and then that gets trued up when they file their tax returns. But you have to actually withhold those source deductions from their pay. CRA's money, and it's due on the 15th of the following month, every month, okay? So where clients get into trouble is that money first, is sitting in their bank accounts. So that 13% that they collected from their customer, it's in the bank. And if things are tight and they're looking at, geez, suppliers, I've got to make payroll. I've got to pay my suppliers because I ordered inventory 45 days ago and I haven't paid them. They'll look at their bank balance and they'll say, okay, yeah, go and pay these bills, and they don't realize they're dipping into that HST that they've collected from the clients, from their customers, okay? Yeah, you could do that. There are, it's a little cumbersome in terms of trying to, manage two different bank accounts and apportion the HST. But yeah, for sure, it's funny, I think a lot of the banks are talking to their clients about doing that because this is such a problem. It wasn't as much a problem when HST was 5%, but when it went to 13%, it became a whole different issue, because that could be, a lot of money if you're, depending on your sales, if you got $1 million of sales a month, I mean, you're collecting a whole bunch of HST and cash is tight. It happens all the time. Again, from a cash flow budget perspective, be conservative but be realistic. You might want to use different scenarios to look at the sensitivity in your cash flow budget. So, you're optimistically, here's where we think we're going to be, but what happens if this doesn't come through? How do we plan for where things may not go to plan? So, quick overview on financial statements. Balance sheet. Has everybody heard of a balance sheet? Okay, so there's 3 main statements in a financial statement, and the balance sheet is one of the 3. And what the balance sheet is it's a snapshot of your business in a point in time. So if your year end is December 31st, when you produce your financial statement, it'll be dated December 31st. And what it'll tell you is the assets that you owned on December 31st. So what did you own? What were the values? The liabilities. So what were the debts that the company owed on December 31st? And assets minus liabilities gives you the equity. So what is the owner's investment in the company at December 31st? And this is what the balance sheet looks like. So there's 5 main sections, okay, but really only 3. You've got the asset side of the balance sheet, so cash, receivables, inventory, equipment, goodwill, which is outside of the scope of this. So this is the asset side of your company. And this could be a corporation or it could be a proprietorship. Current liabilities, so what were the accounts payable, like your suppliers? What did you owe your suppliers on December 31st? How much did you owe in taxes? How much did you owe back to the bank in the next 12 months? So the current portion of your long-term debt represents what you owe the bank in the next 12 months. It's the current portion. Then what's the long-term portion of your debt? So what do you owe the bank, in the longer term? So this is a snapshot. It's a point in time. So the income statement. So the difference with an income statement, obviously revenues and expenses are the main component of an income statement. But an income statement is for typically a 12-month period. So your balance sheet was on December 31st, but your income statement's from January 1st to December 31st, 12 months worth of activity. It'll tell you your 12 months of revenues that you earned, 12 months of expenses that you paid or incurred, and then the difference, of course, between your revenue and your expenses is your net income. So this is the statement you're probably all quite familiar with. And this is what it looks like. So at the top, you've got revenue. And cost of sales, as I mentioned, that was the cost to earn the revenue. So that could be the cost of your inventory, your direct labor. And the difference between your cost of sales, or your revenue and your cost of sales, is your gross profit. So that's what you earn just on your sales in terms of profit, okay? And it's often expressed as a percentage because that term sometimes is used to, how are you comparing to your competition? So in terms of gross profit. You're earning 46% in this business, maybe your competitor is earning 52%. So gross profit is a metric that's often used in evaluating the profitability of a company, at least on its sales. Then you've got below gross profit, you've got expenses. So what were your salaries and benefits? What were your office supplies and utilities? All those sort of selling, general, and admin expenses, they show up below the gross profit line. So your gross profit less your expenses gives you your earnings before income taxes. So that's really your net earnings. So how much profit or loss did you generate in that 12-month period, okay? And then, of course, you've got income taxes. If you made money, corporately, you'll pay 15%, typically 15% corporate tax, and you're left with net earnings, which is after income tax. Does anybody have any questions about the income statement? I'm sort of flying through them, but if anybody wants to, any questions about the statement? No? Okay. Now, the cash flow statement. So again, I said I was going to harp on cash flows. Every financial statement has a balance sheet, income statement, and cash flow statement. And arguably the most undervalued financial statement in all three is the cash flow statement. But I think with a small business, especially a small business startup, it is likely the most important financial statement. So a lot of attention given to the income statement, what your revenues were, what your expenses were, and how much profit you made. But I think we need to be spending more attention to what were the sources of cash, where did you spend cash, because that's really what matters in your first couple of years in business. So 3 categories, again, and this goes back to that slide where the sources and uses of cash. You've got cash flows from operations, cash flows from investing activities, and cash flows from financing activities. And here's what it looks like. So the 3 sections are just built, separated here, here, and here. So you've got, you'll see in the top, cash receipts for customers. So you might have had sales of $3 million for the 12-month period, but how much cash did you actually collect from your customers? And in this case, you collected just about $2.2 million. So that means there's $800,000 that still has been paid from your customers, right? So this statement breaks down what were the sources and uses of cash. Acquisition of equipment. So here you can see they spent $75,000 buying equipment, right? The balance sheet and the income statement won't tell you that. It's the cash flow statement that'll tell you that. The banks will use this statement because they want to know how much money you're spending on capital, so equipment. If you take all of your operating profits and go and invest it in equipment without going to the bank and probably talking to them about whether or not you need a term loan, you might be in trouble when you go to renew your loan. They don't want you to be using your operating profits to fund long-term assets. And I'm going to show you, as I mentioned, the different types of financing you want to use to make sure you're managing your cash flow properly. Like, it doesn't make sense to take the profits you earned in 1 year and spending it all on a piece of equipment that's going to generate profit over 10 years, right? That's where you get into trouble with your cash flow. So pro forma financial statements. So this is really what we're talking about tonight, okay? Pro forma just means forward-looking statements. So your projected income statement, your projected balance sheet, and oftentimes you're going to need these statements, which is why it's a good idea to go through this exercise now, because the bank and investors and even yourselves want to understand what that financial outlook is. So what's the business going to look like three years down the road, to the best of your guess, okay? And in order to fund, to go to the bank with a request for a loan, they're going to want to understand the financial picture of your business. So that's why it's very important to go through this exercise. To put these together, I'm going to show you the template that'll get you started with, the basic components, but you're probably going to need some help from an accountant to actually put the statements together properly. So in terms of producing that balance sheet, it gets a little complicated, but as long as you guys can pin down that sales forecast, the expense budget, and the cash flow budget, pro forma financial statements can be produced for banking purposes and that sort of thing. So here we're getting into financing. So what are the different types of financing? Well, bootstrapping. Bootstrapping is, you guys coming up with your own personal money, maybe family loans, whatnot to start up your business. Traditional lending, these are your traditional sort of term loans. Leasing, as we mentioned. There's different sorts of grants. The NOHFC, maybe perhaps you've got some equity financing, so you've got a partner or an investor that's coming into your business. So these are all the various sources of financing. So in terms of the types of financing, what you use them for, an operating line of credit is basically a loan that you can draw on and repay as you need it. Okay, it can be a short-term loan and repaid once you collect that receivable, and it's used to fund your short-term financing requirements. So it's to deal with, either the cyclicality in your business, or you use it so that you can grant credit to your customers. So if you want to give them 30-day terms, maybe you've got to, you got to pay for the inventory and you've got to dip into your operating line of credit until that receivable gets collected. Term loans are used to buy capital assets. So a term loan is repaid over several months or years, and you use term loans to buy those longer term assets. So what you're doing is you're matching the cash outflows to repay the loan with the cash inflows of the asset. And hopefully the timing of those inflows and outflows line up. And that's the whole idea behind aligning your financing with the type of assets you're buying. Mortgages, they're typically used for land and building, leases for equipment, vehicles, that sort of thing. Shareholder loans. So this is where you're lending money to the business because you want to get it off the ground. Well, if you lend money to your company, the company owes you the money back, and that's called a shareholder loan. The other point I'd like to make is, when you do go to the bank and sign up one of these loans, there's a lot of legalese in the agreements. There's a lot of terms and conditions. So you need to review those agreements with your lawyer, your accountant. Make sure you understand the type of security they're asking for. They're often, a thick document. You may have to personally guarantee the loan, which is likely. What does that mean? They're going to take a charge potentially on your house. So if your company doesn't repay your loan, they've got potentially recourse to sell your house. Well, that's a pretty serious decision, right? So you need to make sure you understand what you're pledging as security. So what do lenders look for? Well, of course, they want to make sure that you've thought through your business plan, okay? That it's well thought out, that your assumptions, you've vetted them, they make sense, that sort of thing. They're going to look at the depth of management. So what kind of experience do you have running a business? It's not a requirement, but if you do have that management experience, that's something that they're going to look at. It's qualitative and quantitative factors. It's not just maybe what the numbers look like. They're going to want to know your own creditworthiness. So corporately, if you're already in business, do you have a good credit rating? Personally, do you have a good credit rating? Typically, if you've got poor credit personally, that may mean something about perhaps how your business is going to be run, or the creditworthiness of your company. So they consider that. You'll actually have to provide typically a personal balance sheet, it's called. So the bank will want to understand personally what your income is, what debts you have, and that sort of thing. Again, pro forma financial statements, that's likely something they're going to ask for. Owner investment. So the bank will often look to lend you money but require you to put some of your own money in. So typically a bank will say, we'll lend you $2 for every dollar that you put in. They don't want to be 100% at risk of your business going south, right? They want to share that risk with you. So depending on how solid your financial projections are, that ratio may be a little bit different, but typically you can expect that you're going to have to put your own money in, or you'll have to support the loans or the credit, using your security like your personal assets to secure their loan. So those are things like GSAs, which is a general security agreement. So that's where the bank takes security on your receivables and inventory. So they'll have a first charge on your inventory. If they decide to call their loan, they'll first look to sell your inventory and collect your receivables and use those proceeds to pay out their loan. So that's called a general security agreement. And that'll be on every loan that you get. They may take, they may take a specific charge on an asset. So you go to the bank to get an equipment loan. They'll say, yeah, we'll lend you the $100,000 to buy this piece of machinery, but we have a charge on that equipment. So they can force you, if things went bad, to sell the asset to repay their loan. Then they look at things like your ability to repay debt. So as I mentioned, typically the bank will say, we'll lend you $2 for every dollar of equity that you guys put into the business. And they'll measure those ratios annually. So as part of your annual review, you'll do your year end and have a financial statement produced. They're going to measure those ratios and make sure that you're on side with them. Those are called covenants, okay? So if during the year you've gone and taken on a whole bunch, you've gone to a different bank and taken on another loan, and now that ratio is 3 to 1, you're going to have to deal with your bank on it, because now they're in a position where the business may have too much debt relative to its equity, okay? So that's where the banks use financial statements to kind of measure where you're at during the year. They also look at a thing called debt service coverage, okay? Getting a little technical, but what that means is they want to make sure that you've got cash flow that's sufficient to repay your debt, okay? So in an example where you take a $100,000 loan and let's say your annual principal and interest payments are $20,000 a year, well, they want to make sure that you've got $30,000 worth of cash flow to fund the repayment of their principal and interest, okay? And that's a function of your profitability, okay? So those are ratios and things that the bank use to make sure you're keeping in line with where they feel comfortable. So matching financing to needs, again, a company has different capital. Like a business is comprised of different capital. It's comprised of its fixed assets. It's comprised of what's called permanent current assets. So it needs a certain amount of cash, receivables, inventory, just to be able to do business, just to be able to extend credit to your customers and that sort of thing. Those are called current or permanent current assets. Then you have fluctuating current assets. So this is dealing with, the cyclicality in the business, okay? So that's a typical capital structure of a company. So what you do is, for the permanent and fixed asset side of your business, you fund that with long-term debt and equity. So your owner's investment and your long-term debt. Short-term debt is what's used to deal with that fluctuating component. That's your operating line of credit, okay? So we've talked about that, but this is just an illustration. So very quickly, I'm going to take you guys through this cash flow example, and this is going to, I think, highlight some of the things we've talked about, okay? So in this scenario, John has developed an innovative product, okay? John incorporated a company on January 1st. He's getting ready to start his business, okay? In terms of assumptions, so John has done his homework, he understands his market, he knows what his price point is, and he thinks he can earn a 50% profit on his sales. So this is sales less, call it inventory, should be able to make 50%. And he expects that his business over the next 36 months, over 6 months, is going to accelerate, in that sort of hockey stick curve. Revenue that he collects on his sales happens 30 days after he makes the sale. So he collects his receivable within 30 days. But because of the manufacturing lead time, he's actually got to place his order with his supplier and pay them 1 month ahead. 1 month ahead of actually receiving or placing the sale, okay? So John needs about $2,500 a month just to sort of maintain a salary while he's getting the business going. And he's going to use his own money, $50,000, to fund the startup of his business, okay? Now, a family member's offered to loan him 25%, or $25,000, but the interest rate was too high, and he decided he didn't think he needed it, okay? Of course, we'll see if he needs it or not. So here's just a projection so this is his revenue projection, the sales side, okay? So he starts up in January, he knows that he's got to pay himself $2,500. He's forecasting $12,500 in sales in the month of February, and then you can see how March it goes up to 37.5, 62,000. And he's looking at, at the end of July, having a net income of $82,000. So, this looks like a really good business, a very profitable business. and could be a real life scenario depending on the type of growth you expect. Okay. So let's look then at how this translates into cash flows. Okay. So the top is your income statement. So this is what he's projecting. He starts with $50,000 in January, and this is that formula. Starting cash plus what he collects, less what he puts out, gives him his ending cash. Okay, can everybody see that? It's a little bit small, and there's lots of numbers, but I think we'll make these slides available to you if you want to go through it later. So in the month of January, he's got to pay for the inventory that he's going to sell in February. So that's a cash outflow. He's also got to pay the bills at home, so he pays himself $2,500. So he's used $87,500 of cash. He's left with $41,000, and that's what he starts the next month with. Okay. Now in the month of February, he's got to pay for March's inventory, and now he's ramping up. So he's having to place a larger order with his supplier, and he's got to fund that. Now he hasn't collected anything yet on his February sales. So anyway, long story short, if we go through the numbers, you'll see here that because of that growth, especially when he goes to pay for April's orders, he's actually in a negative position. His cash flow is dipped to the point where he may not, if he doesn't have an operating line set up, he can't perhaps make that supplier payment. And this is the exercise I think that's very important for you guys to go through in order to sort of understand the ebbs and flows, the ups and downs of your cash flow, right? Because you want to get those things in place before hitting the cash crisis. It's very difficult to go to a bank, when you're in the negative. It's a lot easier to deal with it up front. Okay. So the next slide just shows if he would have taken the $25,000 loan or had the operating line in place, obviously he can make it through that negative cash flow position, and he lives to sell another widget. So just leave you with some tools and resources. So Regional Business Center, a great resource for a whole bunch of different materials. Northern Ontario Heritage Fund, it's a great Northern Ontario program, loans, grants. I'm not sure how many people are familiar, but their website's got information on their various programs. Maybe your business, has a product or may qualify for a grant or a loan. FedNor, I'll leave these to your attention, but some really good resources. I think the first step you've taken is to be part of this program, because this program, is excellent. This is, I think, the third or fourth year we've been involved, but we've seen a lot of great things come out of it, a lot of good resources and things like that. One of the things that Haley and I were talking about before starting is, as a firm, we're sort of, partners with this program. So not only doing presentations, but I think we got some time carved out the week of March 9th, the week next Wednesday. So we've got, some managers, myself, that will sit down with you and spend some time talking about your business. If you want to go over some of the numbers or needed some help with getting your template set up to start doing some of this stuff, that's sort of what we'll contribute. So that'd be a really good starting point. Outside of that, the Regional Business Center has a lot of good resources around actually helping you with your business plan, I think, and that kind of stuff, so you can reach out to them as well. But yeah, first step, I think, is this program. So. I guess it depends. It depends on your business. Depends on volume of transactions and things like that. There's a lot of off-the-shelf software like QuickBooks or Simply Accounting that you can get. It's a couple $100, let's say, to get it established. Those two software are probably the most used by accountants for small businesses. So your accountant would be very familiar with those products. So if they're doing your year-end, their staff are trained on them and all that kind of stuff. The online, some of the cloud-based, actually, QuickBooks and Simply Accounting, which I think is Sage now, both have sort of cloud versions, doesn't have the same functionality. So long story short, you should probably sit with your accountant and find out what's best for your business. The online ones may work. If you're in a simple service business, not a whole high volume of transactions, you're traveling all the time, you've got to send customers their invoices, you can do all that online, that's all great stuff, but it's not right for everybody, right? If you've got payroll, for example, you're probably going to need sort of one of these other more robust products. If you're dealing with inventory, the ones that are online just don't have the same, at least yet, don't have the same functionality. Okay, great question. Like, you know, I don't know that there's, I guess, you know, you need an accountant and a lawyer and, you know, all these different professionals at different stages of your business. So I think, you know, if you're in the startup phase, good idea to sit with an accountant and get feedback, as I was talking about. If you start getting into, like you could deal with, depending on your banking, for example, your banker may dictate what type of financial statement you need. So, you know, we didn't get into that here, but there's different types of financial statements an accountant puts a report on. So that could be a notice to reader, a review engagement, or an audit, okay? If you're borrowing $500,000 or more from the bank, they're going to want a review. And a review is, you know, we do more work on the financial statements to make sure they're more accurate. An audit is sort of full-blown, you know, we're signing off that we think there's nothing wrong with them kind of thing. So I guess to answer your question, I always think it's a good idea to get feedback from an accountant or consult when you need, you know, on tax or financing or business strategy, that kind of stuff, advisory type work. If you're at the point where your business is just starting up and you can work with a bookkeeper that helps you take care of your payroll, your basic, you know, recording your transactions and things, you don't need necessarily a public accountant for that type of stuff. But as you move into these other sort of taking on debt and that kind of stuff, you know, when you start getting that revenue volume up, for sure you should be talking to you know, a professional accountant. There's a lot of you know, obviously beyond the scope here, but I mean, in terms of how do you pay yourself? Like, do you take a salary? Do you take a dividend? You know, there's all different sort of, and that could impact your cash flow as well. Like, you know, do you make it a January year end so you defer tax on the dividend for a year? There's all sorts of strategies. So I think it's better to at least make sure you have an early consult with an accountant to figure out what you do need. Because there's probably a lot that you're not, may not be familiar with yet that you need to consider. Not necessarily more or less attractive. I think, you know, banks are getting more sophisticated, so they would be concerned with, probably what we would be concerned with and what you should be concerned with is, you know, do you need to incorporate because you're trying to either manage risk, so a corporation is a separate entity, you know, so maybe you need to isolate that liability from yourself, you know, what does that mean, like in terms of how you're set up. So, you know, I don't think a bank has a preference of one or the other. I think it's more of making sure you've got the right type of structure. I mean, there's proprietorships, there's partnerships, there's corporations, different types of corporations. So I think you just want to make sure you've got the right structure that fits your business. Yeah. Thanks.